All right. My name is Chris Campbell. I'm a practicing CPA and I work with small to mid-sized businesses and individuals to help them pay the least amount of taxes possible while keeping them out of jail. So today I wanted to talk about accounts receivable and bad debt and the effects that it can have if this is not tracked properly. So what brought this about, I was working with one of my clients and they have a good amount of accounts receivables, right? And what ultimately happened is that we inadvertently were overstating the revenues, at least from a reporting standpoint. From a cash standpoint, we were all good. But from a reporting standpoint, we were overinflating the revenues because we weren't on top of how the bad debts were treated. So long story short, because there are so many accounts receivables and it's hard to track each one individually, what we wound up doing was doing it in bulk, in mass, by different reports, by seeing what was outstanding. But long story short, this did not account for the actual bad debts. So what was happening here was that they looked at the accounts receivables reports and assume that fluctuation in the accounts receivables either accounted for any fluctuation in the report or any decrease in the accounts receivables, assume that revenues were collected and not taking into account that there were bad debts factored in there, right? So obviously if there's bad debts, it's revenue that you never collected. So inadvertently, we had wound up overstating revenue, like putting in the numbers. Now, this is important for a few reasons. So one, if you are in the process of, or if you're in a situation where you're looking to evaluate a business to purchase, and you know that business relies heavily on accounts receivables, one of the things you'll want to do is find out what the practices are for bad debt, how that bad debt is recorded, how often it's recorded, and just make sure that it's properly recorded. Because if not, if you're valuing a company or buying a company based on receivables that do get booked as revenue, right? So receivables are ultimately invoices that billed, but you haven't been paid yet. So if you eventually don't get paid on those invoices, or what's the rate that you don't get paid on those invoices, but from a financial standpoint, it's getting recorded as revenue, it can inflate the value of the company. Like if you're buying based upon the revenues of a company, and you obviously don't want to buy a company for revenues that ultimately never happen, if the cash ultimately never comes in the door, right? So that's important to know. Make sure you understand the process that a company goes through in recording their accounts receivable, right? And then the flip side is that if you're trying to put yourself in a position where you either want to sell, you want to do some sort of financing, you factor your receivables, where and factoring is where you receive money in advance for your receivable. So let's say that you invoice someone and then let's say you don't get paid for, say, 90 days out and don't want to wait that long for the cash. There are companies that will, what they call factoring, where they will front you the money for a fee, obviously, but they'll front you the money on that invoice. And then that factoring company will receive that invoice. So instead of you waiting to get paid, you get paid earlier. So that's another factor, but it is important that you are just tracking your bad debts and tracking them properly. So just a word to the wise there with that. Just make sure you stay on top of your bad debts. And when evaluating a company, just make sure that, you know, the bad debts are in order, or at least the process for calculating and factoring the bad debts are in order. All right. So that's all for now. Hopefully this was helpful. And if you have any more questions about this topic or any other tax or accounting related questions, please feel free to reach out. Myself and my team, we're happy to. All right. So that's all for now. And I'll talk to you in the next. Take care.